Hello, and welcome to the second in our Investing 101 presentations. And today we're going to talk about fixed income investing. My name is Doug Richards. I'm a financial planner with Securities America Advisors and the owner of Crest Financial LLC. What is fixed income investing? Fixed income investing is usually equated with investing in bonds. Other fixed income instruments may include preferred stocks, peer-to-peer lending, and bank instruments like CDs. Usually, investors invest in fixed income vehicles for a variety of goals, including generating current income, reducing a portfolio's volatility, the possibility of tax-free income via municipal bonds. And for today, this presentation will primarily focus on bonds. So what is a bond? Well, it may help to think of bonds as promises. An investor loans money to a borrower who promises to pay the money back. Two key items to consider when thinking about bonds like promises. Number one, who's making the promise? And number two, how long is the promise being made for? So who is making the promise? We've all been around long enough to know that not all promises are equal. Bond issuers, just like us, have credit ratings. Bond ratings start at AAA and go down to unrated. Stronger promises or higher rated bonds are more credit-worthy issuers and generally have to pay you less to believe their promises. In other words, a AAA bond will usually have a lower interest rate than an unrated bond, everything else being equal. Issuers with lower credit ratings are often called high-yield bonds, which may also be known by their old name of junk bonds. Historically, high-yield bonds have provided approximately 3/4 of the returns of the stock market with only half of the volatility. The next consideration is how long is the promise being made for? Usually, longer-term bonds pay a higher interest rate to give investors compensation for locking up their monies. When shorter-term bonds have higher yields than long-term bonds, this is called an inverted yield curve. Historically, an inverted yield curve has been an indicator of a possible recession, or using the promise analogy, with an inverted yield curve, investors are putting a premium on near-term promises, and long-term promises are not as desirable due to uncertainty. What risks are there with bonds? There's no such thing as a risk-free investment, and this is especially true with bonds. With bonds, we need to be concerned about issuer or default risk. This is the risk that a bond's issuer may become unable to repay the investor. Default risk is higher with bond issuers who have lower credit ratings, and during a recession, bond defaults generally rise. Interest rate risk. Bonds and interest rates have an inverse relationship, such that when interest rates rise, the bond prices will decline, which may result in a loss to the investor. This is if they need to sell their bond before it matures. One measure to help you understand interest rate risk is to look at a bond portfolio's duration. Portfolios with a higher duration, usually longer-term bonds, will have more exposure to changes in interest rates relative to portfolios with shorter-term bonds or lower durations. As an example, a bond portfolio with a duration of 6 may lose 6% if interest rates were to increase 1%. Conversely, if rates were to decrease 1%, we might see appreciation of approximately 6% in the same bond. The next risk is reinvestment risk. Reinvestment risk is something that happens when rates are declining and new issues pay less than your current bond. So the risk is that your proceeds from your bond will be invested at a lower return. If you're investing outside of the United States, there's currency risk, and this occurs when the currency of an underlying security declines. All other things being equal, you'll see a decline in your holdings value. Inflation risk is the risk that your investment will not keep pace with inflation and that your purchasing power will decline over time. Liquidity risk is not as common, but it happens when a security has a limited number of buyers interested in purchasing the underlying security, and this may make it difficult to sell or liquidate your investment, which could be problematic if you need cash. Bringing it home with our conclusions, fixed income investments are a critical piece of a diversified portfolio. Two of the primary benefits of fixed income investing are generating cash flow for the portfolio and reducing volatility over the long term. With a wide variety of fixed income securities, from bank instruments to peer-to-peer lending to municipal securities, it makes sense to have an experienced professional to help you develop and manage your fixed income portfolio. Professional, objective advice incorporating your goals, time horizon, and risk tolerance can make a difference in your success as an investor. Please consider Crest Financial. We work with corporate retirement plans, foundations and trust, business succession and executive compensation planning, personal retirement and estate planning, investment planning and portfolio monitoring, and risk management planning. Crest Financial, we believe in clear fees, clear services, and take an approach that's clearly different. Again, my name is Doug Richards. I can be reached at doug@crestfinancialllc.com or 541-868-0449. Thanks for your time today. Have a wonderful day. And please don't hesitate to contact us if we can be a resource for you. Thanks so much.